Get to Rick Santelli standing by at the CME in Chicago. Rick, the numbers, please.
All right, second walk around the block on GDP. I lost a tenth, as expected, actually, holding 2% originally. First look was 2.1. We have one more glimpse, of course. And the personal consumption numbers, though, maybe the most important component, moved higher substantially, actually. 4.7 versus 4.3. The price index holding steady at 2.4. The core personal consumption expenditure, quarter over quarter, dropped a tenth to 1.7. All right, let's go to claims. I'll jump around. 215,000, which is a rise of 4,000. But the 4,000's from 211, originally released at 209. Okay, let's go back a bit. Let's go to the trade balance, expecting a number around $74.5 billion, $72.3 billion, so a bit lighter than expected. And if we look at retail inventories month over month, that's July, they were up 0.8. So that's more than we expected, and that is going to boost GDP numbers with regard to the rise, of course, of widgets. Now, if we look at wholesale inventories, and this is a preliminary number, it came out as expected, up 0.2. So there's a lot of data points there. All I can say is that in the end, I like seeing these July inventories move up a bit. We all know that we're keeping track of some of the revisions on Q3. First quarter is always supposed to be the weakest. We actually didn't see that. We've seen a little bit of moderation, of course, in second quarter numbers. Looks like third quarter could outpace it. Everybody, of course, is completely paying attention to all the trade issues and all the cottage industries and supply chains involved in that. But maybe we should also look at the macroeconomic data as the world slows, and maybe our inverted curve is more of an international signal now because of all the influence on our long end from an international perspective. But the U.S. economy isn't doing badly. Could it do better? It can always do better, but it's doing okay, maybe okay plus. Becky, back to you.
Rick, stay with us. We've got more to talk about. Steve Leisman is here, though, too, and he's been digging through those numbers as well. And what's your takeaway, Steve?
Can I just spend a minute saying how great Rick is at that?
Yes.
I've tried to do that. They don't let me do it because
hard.
I'm terrible at it. He sits there, keeps his cool. All these numbers are flying around. Do they have them? Just does a great job.
And by the way, he's looking off screens way
way off over here,
and
and it gives me a little bit of time to talk about it. Let's Rick, I'm going to say something, and you say higher, okay? Because you say it's so great,
higher.
Okay? The consumer spending. Rick.
Higher.
Okay. Let's see what else. Durable goods inside that, Rick.
Yeah, no, these are
higher.
all very, very healthy.
All right,
Yes,
now we don't have the lower here because business investment still down 0.6. Structures down a little bit better than expected. Intellectual property was up 4.7, was up 3.7. Our rapid update was housing investment also a little bit more negative, minus 2.9. And government purchases about the same. Trade took away about 0.75 of a point, with most of that from the export side. That could be linked to the strong dollar, which brings us right around to President Trump and his call for lower interest rates to reduce the dollar. Rick, what do you think about that? Give me your take on whether or not this is the question of our age. Should the Federal Reserve be lowering rates in order to weaken the dollar and help U.S. exporters?
I think that would be a horrible idea. Horrible idea. I think the firm dollar is a testament to our economy, and I think many of the economies that have weakened their currency, either by managing it and fibbing a bit or just saying, it's just monetary policy offshoots, their economies aren't accelerating. This whole conventional wisdom notion, you lower your currency, your export market rises. Maybe there's a counterfactual there, and their economies wouldn't look as naughty as they look now. But in the end, I think the president, when he referred to the giddiness of the G7 leaders over their low interest rates and weak currencies, just underscores how much drinking must have been going on in France.
I agree. I don't think they're giddy about that. As I said, Rick, if you want Germany's interest rates, you can have Germany's economy, which printed a negative print in the second quarter. And you can also have the UK's economy, which was flat to negative in the second quarter. We have 2% growth. And the question is whether between me and Joe, where Becky sits, the twain can meet where Joe would argue, I believe, I'm going to put words in your mouth, you think the right run rate of the economy is 3%. And I'd argue that there's a lot of good evidence that it's more like a 2% economy, and we're doing as good as we can or should be doing.